Today, US debt and the ANZ Interest Only play. Hello again, I'm Martin North, the Principal Analyst at Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Two topics for today's post. First, US debt continues to rise, with the strongest growth in the public sector. And second, ANZ launched a new interest-only mortgage offer, which marks another of my predicted unnatural acts. The question is, will APRA let it pass? And by the way, if you value the content we produce, please do consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or consider joining our Patreon program. Again, here is the link. We really appreciate your support to help us to continue to make great content. Links are also in the comments below. First, to the US. Moody's pointed out that the latest version of the Federal Reserve's Financial Accounts of the United States, which was released on the 7th of March, showed that as of 2008's final quarter, the total outstandings of private and public non-financial sector debt grew by 5.1% year on year to a record high of $51.79 trillion. The year growth rate of the broadest estimate of the US non-financial sector debt has slowed from the second quarter 2008's currently high cycle of 5.6%. Since the end of the Great Recession, the 3.9% average annualized rate by non-financial sector debt has slightly outpaced nominal GDP's accompanying 3.7% average annual increase. And by contrast, during the 2002 to 2007 upturn, the 8.1% average annualized advanced by non-financial sector debt was much faster than nominal GDP's comparable measured growth rate of 5.3%. As a result, the moving year-long ratio of total non-financial debt to GDP climbed from 197% of 2001's financial quarters to 225% of 2007's final quarter. Now, because of the current recovery's much slower growth of debt vis-à-vis GDP, debt barely rose from the second quarter 2009 243% to fourth quarter 2018's 249% of GDP. Today's near record high ratio of non-financial sector debt to GDP limits the upside for benchmark interest rates, they say. Just as highly leveraged businesses exhibit a more pronounced sensitivity to higher benchmark interest rates, highly leveraged economies are likely to slow more quickly in response to an increase by benchmark rates. Relatively low interest rates do much to lessen the burden implicit to the comparably high ratio of debt to GDP. Nevertheless, a powerful enough external shock could force US benchmark interest rates up to levels that shrink business activity considerably. And under this scenario, they say, the Fed will be compelled to hike rates in defense of the dollar exchange rate, despite how a deterioration of domestic business conditions requires lower rates. The federal government has dominated the growth of total non-financial sector debt during the current business cycle upturn. In terms of moving year-long averages, US corporate debt's 9.3% averaged annualized surge has well outrun the accompanying 2.2% growth rate for the sum of private, state, and local government non-financial sector debt. And now to ANZ. They announced a new flavour of interest-only loans. They said that from the 25th of March 2018, they'll increase the maximum loan-to-value ratio of interest-only loans from 80% to 90% and increase the maximum term from 5 years to 10 years. They are marketing these products only to high-income professionals with stable jobs. And the timing means people could transact before the election in May, probably, so lock in tax benefits relating to negative gearing, which Labour are going to remove for existing property purchased after a certain date to be announced. They say that ANZ's response to APRA's responsible lending guidelines from 2017 was to manage the growth of interest-only loans, but they have decided to increase their focus on the investor market, whilst ensuring they remain in line with APRA's requirements. And just to remind ANZ, the key points are, first, take 80% of rental streams as income to allow for vacancy rates. 2, assess the risk on a principal and interest loan rate basis. 3. Ensure the borrower has firm plans to repay the capital. 4. Ensure adequate validation of income and expenditure. 5. Ignore any tax breaks or benefits, so assess on a pre-tax basis. ANZ says these changes will apply to new loans, either fixed or variable interest rates. For owner-occupier home loan products, the interest-only term cannot exceed a maximum 5 years per application or 5 years in total since the last full credit critical application. But for residential investment home loan products, the interest-only term cannot exceed a maximum 10 years per application or 10 years in total since the last full credit critical application. And for servicing, customers are assessed based on their ability to repay the loan over 20 years, principal and interest. And we understand these new loans are assessed at a minimum floor rate of 8.25%, which is a very high hurdle to cross. And these are not available to owner-occupied borrowers. Now, there are 2 comments. First, this is to be expected as ANZ has seen their mortgage portfolio growth drop away, and they are desperate to write business. And they're trying to target a specific customer segment who currently are facing a loan reset and therefore may be rescued. But then our modelling suggests a very small cohort who might be eligible, and we expect other lenders to react, so they will lift competition for that small segment. And talking of reaction, we think APRA should step in to ban loans for this duration, but they probably won't, and the RBA might even welcome the move behind the scenes as generating a rise in credit. But frankly, this is just one more of these unnatural acts I keep talking about from actors who are trying to keep the property bubble alive. But potential investors should realise that prices are likely to keep falling. Rental streams are diminishing, especially in Sydney, and a repayment plan over 20 years will require higher monthly repayments down the track. This has high risk written all over it. Just before I go, a quick reminder that we're running our live stream event next Tuesday at 8 p.m. Sydney time. You're welcome to join us in the live chat and ask me a question, or if you want to ask questions beforehand, you can send them through via the DFA blog. The links are in the comments below. And here is the link to the live stream event. I look forward to seeing you there. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.